So this is our first podcast, gentlemen, since we began the second half of 2022, beginning on July 1st. So we had the 4th of July weekend, and now we're into another week in the month, a full week. And this first half of the year in the market, which the S&P was down roughly about 20%, and the NASDAQ technology down 30 on the average. But a lot of the headline names, big time tech names, are down 40, some 50% for the first half. It turns out was the worst first half in 52 years since 1970. So everybody got really hurt in their stock portfolio unless they had some other plan. So 1970 was the last time we had a market as bad as this. And the interesting thing, though, is because interest rates were going up and the Fed is worried about inflation. Now we had the worst bond market ever, actually, in the first half. So if you had a portfolio that was invested in dividend-oriented stocks and you had an opportunity to get out of them or to hold them through that whole period of time, maybe you were down single digits, not as bad as the S&P 500. Or if you had a portfolio that got out, we had one portfolio that was down only about 3% because it went 100% cash earlier in the quarter and has been sitting there. Your bonds, which are down 10 to 12%, might have actually been down more than your stocks for the first half, which I don't think we've ever seen the bond market down in the first half more than stocks. So, Jack, you're the bond and interest rate guy here. What do you make of all this? Why is the bond market down so much, and what happened?
Yeah, well, Brad, we've never really had an inflation scare. You know, I've been at this for 35 years, and I would say what was really shocking was that 8.5 or 8.6% right before the last Fed meeting. They went to the Wall Street Journal and basically tipped their hat to the market that they were going to go 75. You and I have spoke that they should have started this process at the third or fourth quarter of last year. They were really late to the game. There was a lot of stimulus, whether it be monetary or fiscal stimulus, and they really had to get after it quick. Now, I would say that we're seeing with the strength in the dollar, inflation expectations ratchet lower quickly. I do think that this Wednesday and Thursday, the CPI and the PPI numbers are really big for the market, right? Because we could still have another shocking. Keep in mind that these numbers will be for June when gas prices we're still moving up, right? So we may get shocked tomorrow and Thursday, and then once again that brings in more speculation about a more aggressive Fed. But I would say from looking at the yield curve, Brian, they've done a really good job of getting inflation expectations lower, right? And right. we see that with the stronger dollar. We've seen oil go from 130 to 99, 95. We've seen mortgage rates dip from 6% to 5.50. I am not doom and gloom. We are closer to slaying at least inflation expectations, and you can see that in the curve. The two's 10 spread is -9. It doesn't mean that it's not going to go more negative. It could be -20, -30, right? But you could tell from the newspapers and all of the business programs, the talk of recession, Jamie Dimon talking about the hurricane, pullback in bank lending, and just an overall adjustment of asset prices, right? This idea about a 60-40 portfolio, well, the 40% safe bucket was your bonds, really didn't help you very much, right? So I really like our strategy, our rotation models, and this idea that when things get bad, we will go to certain percentages of cash, right? All of our investors like the idea that in retirement, they got somebody who has their back, basically. So
Well, and let's talk about that. So in this first half, if you take a look at your statement that should be arriving in your mailbox right now or available online, if your portfolio is down big and you're really stressed out about it, and then when you watch the TV and you see with a day when the market's down and it makes you really nervous and stressed out, well, then you probably have the wrong portfolio. That you need to get in a position where you're not so worried about every decline, because there might be more declines. We're not trying to be negative about the way things are, but based on the trends in the economy, it's possible that the markets go lower. We had an interim low recently, about a week and a half ago, and then we've had a little bit of a rally in the market. We might have seen the bottoms, but we might not have. And history would say, we mentioned this on a previous podcast, that the likelihood is that we do go lower. We break the previous low from a week and a half ago and go lower. But we would be thrilled if that was the wrong prescription. And very often, we do not know the bottom of the market until 60 to 90 days after it happened, because we need to get evidence. And we talk about an evidence-based move. There's some videos and about commentary we made on podcasts about we're in an evidence market. We'll put money back in the market slowly as we get more and more evidence that things are better and better. So we don't flip overnight. It's not like a switch where you turn the light on or off. It's more like the dimmer switch. We dim it down, we dim it back, and we raise it back up. So we're in the process now of possibly raising it back up, but we were maximum protection as recent as about 2 weeks ago. And we've been that way for about 5 to 6 weeks before that. So we put a piece out about what will the market do. And the truth is, we don't really know. But we know what we'll do when we get different bits of evidence. So we're in the position right now where relative strength is saying the market's looking a little bit better. But history would say it probably goes lower. So time will tell, and we wait and we watch and we see what happens. And then we'll know what to do. Talking about the economy, though, Bob Barone, our economist, just recently appeared with his partner, Josh Barone, the chief investment officer of Universal Value Advisors in Reno, and they're also 4-star associates. And Bob said we're already in a recession.